want to move along now to a topic that's sort of unique to 2011, which is .com IPOs. It should sound kind of familiar because we had a wave of .com IPOs about 10 years ago, and we should all remember how that worked out. The prices were inflated, the valuations were inflated, a lot of hype, and in the end, it all came crashing down, as every bubble does. Now, .com companies are different from brick-and-mortar businesses or businesses that provide an ongoing service, let's say a phone company, a utility, and things like that. Now, the thing is, many .com companies, on the internet especially, it's very difficult to compete because people could click from one website to another in a second. And maintaining an audience for an extended period of time can be quite difficult because, unfortunately, your customer base on the internet can be quite fickle. And as soon as they find out that there's an alternative that offers even the slightest benefit, they're going to run to that new, better proposition. Now, it's great for consumers because they get to jump on whoever's offering the best product at the time. But it's not the best situation for investors necessarily because no matter how hyped and how anticipated a certain company may be, it may lose its customer base just that quickly. And the .com fiasco showed us exactly how pervasive this could be. Companies went from having millions and millions of dollars of investor capital to being completely bankrupt in 1 or 2 years. So it's really fascinating to see how quickly it can happen. So in 2011, we've, of course, completely forgotten about the events of the .com bubble, and we're starting our fresh internet bubble, the way I see it. The numbers really speak for themselves. One of the web IPOs is Demand Media that came out January 26th, had an IPO price of $17, and this company says Demand Media's January IPO kicked off 2011 with a pop. Shares of the online content creator closed 33% higher on its debut day, valuing the company at more than $1.5 billion. It was a surprising debut considering the criticisms that plagued Demand's road to the stock exchange. Demand CEO Richard Rosenblatt had insisted for years to media outlets, including Fortune, that his company was profitable. But in its IPO filing in August 2010, Demand disclosed that it was more than $6 million in the red for the year so far, and it had posted a net loss of $22 million in 2009. And that's the other thing with IPOs. A lot of these companies were losing money at the time and continue to lose money after they make the IPO. The big issue is that the growth that they experience when they go public, a lot of these companies, is so rapid that all of a sudden they just have this infusion of capital and the company simply explodes in size very rapidly. Then you're forced to make decisions based on a much more inflated machine than you had previously. So, you know, it's quite different when an organization grows organically, which means they open up, let's say, one office at a time, or they introduce one product at a time. They hire on a consistent basis, and they don't turn into a bloated organization, and they don't outgrow themselves. And that's a lot of times what happens with these IPOs is that these companies get an infusion of capital. They're worth a lot more. They're given a tremendous valuation, and they don't really know what to do with themselves, quite honestly. The stock prices of these IPOs tend to show that quite clearly. Another thing about IPOs is that many investors love them because they believe that if you buy into an IPO, you're getting in at the first round. You're really getting in at the beginning. You're one of the first people to the mound, and it's a fresh idea. It's ripe for your picking, and it can only go up. It's not the case. If you're a retail investor and you buy into an IPO, you're the last person in line. All of the big players, the big fish, have already bought in. And when that company goes IPO, they're waiting to unload. They're waiting for that pop. They know about the hype. The financial industry is very smart. They know exactly what's going to happen as soon as these companies go public. Now, the more hype that there is, the higher the pop tends to be, which gives a even better opportunity for the initial investors, all the private equity and so forth, to make a killing as they unload stock post-IPO. Now, who gets hit? The retail investor, every single time. And you'll see these companies, and I'm going to go through a few of them, that just suffer after IPO. And it just shows that, first of all, IPOs are mostly companies that have been losing money, companies that don't even have the most sustainable idea. People tend to really stop evaluating whether a company is a great idea or whether a company can exist 5 to 10 years from now. Let's go through some cases, and it'll become a lot clearer. Back to this company, Demand Media. It says, Demand also faced criticism of its unorthodox accounting methods. Demand doesn't expense the cost of paying its writers up front, as content companies typically do. Instead, it spreads those costs over 5 years, which boosts its bottom line. Now, accounting games are also not unique to IPOs, unfortunately. We're going to get to Groupon in a little bit, and we're going to see the games that they were playing, which are quite interesting. However, they don't really work out too well for investors. It says, analysts marveled at the content churned out. It was amazing. They literally wrote 2 million articles in a year. But Demand's method isn't working as well as it once did. In February, Google rolled out a change in its algorithm that pushed articles like Demand's lower in search results. Uh-oh. So all of a sudden, you have the biggest search engine in the world basically hiding your results from the average search engine user. So one single event can really turn a company like this around. So that's the other thing with the web IPOs especially, that they tend to be very fragile and sensitive to conditions going on both in the markets and also within their respective industries. It's potential for a lot of volatility there. It says, Demand stock managed to hold around its highs for the first quarter of the year, but it's been a sharp and steady decline ever since. Shares have lost more than 65% so far in 2011. Okay, and here's a close-up of the chart. You can see here it started the year at approximately 23, and now it's at about $7, $8. So tremendous losses there. And again, these are many of these investors are getting into it as soon as the IPO comes out, and you're taking a 65% hit in less than a year. So that's one example right there. It's really scary how quickly this can happen and how easily people forget that the IPO for the retail investor is really not the place to be.